This is 2025 FOREX Trading Empire Mentorship Program Lecture 17. The topic for this lecture is weekly candle reversal. Now, I talked about understanding the weekly candle. If you have to use the weekly bias or even the daily bias, you need to understand the weekly candle enough to define it on if it's going to be a weekly reversal candle, weekly trend continuation candle, or weekly counter trend candle. You need to define the candle before knowing where you are trading to. So in this example, I'll be talking about the weekly reversal candle. So we talked about a few things this past week. We talked about deciding on which currency we'll be trading throughout the week. And I asked individual members of the community to decide if we were to stick to Euro USD to be used throughout the 2025, because our intention on starting this mentorship, we plan on using trade currency. But to make it more simple and easy to understand, and to make you guys master one currency, because that's the easiest way to become profitable. Sticking to one currency enough to see more setups with that currency with weekly bias and daily bias. So throughout this 2025, we'll be doing all our trades idea and going into day by day, week by week trade setups on Euro USD, explaining each setup as they occur, the name, and how to trade it next time when price is repeating that same pattern. And remember, we're not trading pattern for pattern's sake. I'm showing you guys the full confluence to the trade setup. So we're going to be using Euro USD. In this trend reversal, weekly candle, reversal candle, price traded to this liquidity void. Now, where you be anticipating this kind of candle is when price trades to a fair value gap, an order block, liquidity void. So with this example, here's an order block, and within that order block, there's a liquidity void. The week before looking for this reversal candle, price did a retracement to the liquidity void and the order block. I was anticipating lower prices. I talked about this in the YouTube channel and I posted the link to the video in the community chat on where I was looking for lower prices. Now, if I'm looking for lower prices where the previous candle was an up close candle, which means on the 4-hour time frame is an uptrend. If I were to look for lower prices, which means I'll be looking for a trend reversal on that 4-hour to lead to lower prices. So I'm looking for a reversal candle. And how to define the reversal candle and how to confirm the reversal is with the 4-hour trend and the daily trend. You need to stick more with the 4-hour, but always look at the daily trend to look at reference points that price might reference to on the daily time frame. But the 4-hour trend is very important when identifying the trend of the weekly candle, either trend continuation, counter trend, or reversal candle. Which this example is a reversal candle, liquidity void. You can see how price closed inside the liquidity void, anticipating lower prices. Now, there are some scenarios where price will run out the weekly high before doing the retracement. Those are high probability scenarios. So you just need to see the shift in market structure. Later on, I'm going to go into more specific when it comes to trend reversal that have a high probability to lead to a complete reversal. On the 4-hour time frame, I'm going to go to the 4-hour time frame. On the 4-hour time frame, here's the opening price of the weekly candle. Here's the opening price of the weekly candle. Always mark out your opening price, which I've talked about is the equilibrium price. We are looking for lower prices. We are looking for price to trade to a discount to lead to lower prices to run out liquidity, like this sell side liquidity, fill of this fair value gap. Now price open traded lower to this 4-hour fair value gap, led to higher prices for price to trade through this weekly high. Now, a trade through this weekly high is indicating that price is running our previous week high to lead to lower prices. If price were to run at this high and lead to a shift in market structure, that's a high probability shift in market structure because they went on offset traders looking for a way to buy, enticing traders to buy, manipulating price, running out significant liquidity, previous week high. After running the previous week high liquidity, led to the shift in market structure. Now, you will only look for setup after the shift in market structure. Don't look for setup. You can look for setup with the daily bias, but at your early stage, stick to the 4-hour time frame when using the weekly idea. That's the weekly bias. Price the retracement to a 4-hour fair value gap, which on a daily perspective, we're looking for a trend continuation for price to run at the previous week high. Price traded higher, run at the previous week high, led to the shift in market structure. Retracement to this fair value gap respected it. Press the retracement to this fair value gap, failed to create new low, traded higher because of high impact news. Price traded back to this fair value gap, respected the fair value gap, shift, traded back to this 4-hour fair value gap, and traded lower. So anytime price retraces to either of these fair value gaps, those are the times you'll be looking for entry. When price retraces to a 4-hour fair value gap or order block, that's when you go to lower time frame and try to align it with section and with the models we talked about. So we'll be looking at individual models to look at on what setup we could identify during those models during those 5 trading days after the shift in market structure. So Monday price shifted structure, on Tuesday price started trading lower, and that was when we started looking for entry. That is the point where you are going to be looking for an entry after the shift in market structure. There's a chances of you catching the shift in market structure after you run the previous week high, but as an early stage trader, I wouldn't advise you to do that. It's possible, but you need to factor in with some ideas before trying to catch the swing high. So you wait for price to shift structure, go below the opening price, or even if price is still above the opening price, as long as there's a 4-hour shift in market structure, then you can still look for lower prices. So on the trend reversal candle, on the weekly trend reversal candle, you want to see the shift in market structure from the 4-hour time frame, and you trade after the shift in market structure. So this is a trade plan. This is how you build up a trade plan. This is how your parameters, your limits. You're limiting yourself so that you can factor in and filter the good trades to have a high probability setups. So throughout this trades reviews, this is what I'll be doing, talking about individual week and both daily bias. I'll be talking about daily bias. I'll be trying to combine them, showing you guys how to combine both time frame. Now, 4-hour shift in market structure. Now we'll go to on Tuesday, where price retraced to the fair value gap the first time, which is this retracement to the fair value gap. Then we'll talk about Wednesday, Thursday, and Friday. First, let's go to the 1-hour time frame on Tuesday. Now, the 1-hour time frame on Tuesday, here's the fair value gap, 4-hour fair value gap. Price retraced to the fair value gap. Now, we'll talk about the 3 a.m. to 4 a.m. entry model. Although you can enter directly from the London section, as long as price is at a specific section that might lead to higher or lower prices, you can just use that section for your entry. We're talking about specific model we discussed on previous lecture. We're going to talk about the 3 a.m. to 4 a.m. on Tuesday. So on Tuesday, price retraced to this fair value gap. Now, if I were to trade the 3 a.m. to the 4 a.m. trade setup, I already have a bias. So this is why it's very important to have a bias. I already have a bias because price is respecting the 4-hour fair value gap. Price is a retracement to the 4-hour fair value gap. And clearly there's a 15-minute shift in market structure before 3 a.m. There's a 15-minute shift in market structure. I already have a bias. I'm anticipating lower prices. Now, where to target? You target the 4-hour swing low, which is going to be your first target. Then you use your Fibonacci, starting from the retracement, starting from the high and where the retracement started from, which is this sell side liquidity we identify. We'll be looking for price to trade to the 100% mark, which price did not actually trade to the 100% mark. I'm just trying to show you guys what I actually did, what was my thought process taking out this trade. My two take profit level will be the 100% level and the 50% level. Before going into the 5-minute time frame, looking at that specific time, pointing out the fair value gap during that time. So on Tuesday, we're going to choose a 3 a.m. to look at the 3 a.m. If I were to use the 3 a.m. setup, 3 a.m. to 4 a.m. setup, now here's the opening price of 3 a.m. Let's make this black and 3. Let's make it 3. So 3 a.m. and 4 a.m. Now, during this price range, you can identify that there is no fair value gap, and the 3 a.m. did not trade into a fair value gap. You only traded away from this fair value gap, which is not an entry when you're using this entry model. So, which means you did not take advantage of any of this trade before the reversal. You did not take advantage of any of this trade before the reversal. So you can see how focusing on those specific trade models do help you sometimes look for high probability setup. So that's why I talked about those specific times. But personally, I took a trade from this. You can see my fair value gap is still, the fair value gap identifier is still at that area. I sold and priced the retracement because I'm more experienced on it and I know a setup that do occur before the 3 a.m. and setup that do occur after the 4 a.m. during the London sector. That was why I sold, anticipating lower prices and for price to form a fair value gap. When there was no fair value gap, I just trade my stop to this high and price the retracement after taking out the first target. Price the retracement and stopped me out around when I was in profit around 1 hour before price stopped me out and did a retracement because I started trading Euro USD back because we on how we discussed on moving to Euro USD for us to trade throughout the year, and I want to put more focus into the trade setups and trade idea. So I'm going to be moving fully to Euro USD and I'll be talking about trades that I personally executed on Euro USD. So price the retracement back to the fair value gap, respected the fair value gap again, traded lower. Now leading to the New York section, price the retracement back, a downtrend. Now talk about trend continuation during the New York section. If I were to look for that trend continuation during the New York section, I'll be paying attention to a 15-minute fair value gap for price to respect the fair value gap to lead to lower prices. Then I'll be focusing on the 8:30 to 10 a.m. setups. So let's go to the 15 minutes. Let's look between the range. Was there a fair value gap to execute on? Now looking at this price range, price open 7 a.m. Price created this swing low and did a retracement back to the weekly range. Now there's no fair value gap within this price range. Here's the fair value gap on the on the 15-minute time frame. We only have this fair value gap, and this fair value gap, when price retraced back to this fair value gap, this was already after 10 a.m. It retraced back to the fair value gap after 10 a.m. So which means it's not actually a setup I'll be taking advantage of. Price did respect it a few minutes before finally retracing and running out the high. For it to go to the 5 minutes, you can see how price traded to the fair value gap, shift in market structure retracement, respected this 5 minute fair value gap, and led to lower prices, but price still didn't actually respected it completely. It still came back. If you had to trade your stop will be at this high before price stops you out and a retracement. So on Tuesday, price mostly consolidated, but because we're sticking to our rules, we were protected throughout the trades that price did a retracement back to our entry. Like the first trade I took, retracement back to this high, stopped out at 1% profit. The same thing goes to this trade. Price did a retracement after 10 a.m., which I executed on it. Retracement, respected it, stop at this high, stopped me out at this high. And that was how on all the trades I executed on, I didn't have the running trade that ran through till Wednesday, and all my trade was stopped out. But between the range of 8:30 to 10 a.m., here's a shift in market structure after a retracement to a 15-minute fair value gap, and price stopped you out at break even if you were to execute on this trade idea. Now moving to Wednesday. Now on Wednesday was actually the day I did cut a running trade. So during the London section on Wednesday, price did a retracement after price traded back to our entry price. Price did a retracement higher back to the 4-hour fair value gap. After trading to the 4-hour fair value gap, on the 15 minutes, which you can clearly see from the 5 minutes, price traded lower. Retracement back to the fair value gap. Let me adjust this fair value gap. Price did a retracement to this fair value gap, which on the 15 minutes is a 15-minute fair value gap. And we're going to pay attention from the 3 a.m. to 4 a.m. trade setup. Now, during this time, price the retracement to this fair value gap, and this will be a fair value gap you'll be executing on because price open. If there's a fair value gap before 3 a.m. and price is retracing to the fair value gap, you can execute on the fair value gap, or you wait for price to create a fair value gap, whatever way you choose. But this is the fair value gap you would have executed on, because if you were to look at the swing high to swing low from the 15-minute time frame, you can see it more clearly. 15-minute fair value gap. The opening price of 3 a.m. did a retracement to the fair value gap. Price respected the fair value gap, led to lower prices. This would have been your first entry. Now, the second entry within that price range, I can still identify it on the 5-15 minutes. I just want to start from the lower time frame before the higher time frame. Now, at 4 a.m. 5-minute candle, 4 a.m. 5-minute candle, price created this fair value gap, traded lower, run out the swing low, left the fair value gap, which this would have been another entry to execute on. Remember, we have a higher time frame bias. We are just using those entry models to look for entry. Those are entry models. And those entry models, those are the specific areas we are looking for price to trade to a fair value gap, or looking for price to trade to our entry level. Now, where are our targets? Now, your first target is going to be this 4-hour swing low. This would have been, this is a 4-hour swing low, but just using lower time frame to identify it, because this led to the retracement back to the fair value gap and price trade to the 4-hour low before even retracing to 3 a.m. So where is going to be your next target? Use your standard deviation on your Fibonacci. The retracement back to the fair value gap, you measure the retracement, anticipating price to create the same price level, to create a standard price level. Mostly that's how price to book price is creating a standard price level. So we're going to be measuring from the swing high of the retracement to the swing low of the retracement, which means we measure from this swing low to the swing high. Our first target is going to be the 50% level, and our overall target is the 100% level, creating a standard deviation. This is our target level, but there's still more ways to target. You can just look at 4-hour swing levels and 4-hour fair value gap, 1-hour fair value gap to look for price to trade to those area. But I'm making it more easier for you guys than looking back at the previous price action to look for swing areas. You can just use a standard deviation to measure the swing low to a swing high and look for price to create the exact standard deviation of this retracement. And I've studied standard deviation. It has a very high accuracy when it comes to retracement on where price will be leading to the next retracement. You can even see this example. As soon as price trades to the 100% level, you can see how price did a retracement back to the daily range before the close of the candle. So you can easily use it to identify daily range. So you can see the retracement exactly at the 100% level. This is something that I've studied a lot, so that's why I mostly use standard deviation as my target. Whenever price will run at the 4-hour next draw on liquidity, I just measure from the retracement low to the high and look for price to trade to the 100% mark in that standard deviation. So 2 trade setup. Here's the first trade. Second trade, where's your target? 50%. Once price trades to your 50%, it's either you take some of your position out, but I do throw my stop because I executed from this first entry, 15-minute entry. So I trade my stop to this high, retracement to the 50% level, and price consolidated, leading to the New York section that led to the last trade lower to the 100% mark, which my stop was at this high before price traded lower. So I trade my stop based off swing level that has a fair value gap. So from the swing low to swing high, there's a fair value gap. That was the reason I moved my stop to this high. Now from this swing high to the swing low, here's the fair value gap. And that was the reason I moved my stop to this high. Price traded close to the stop before trading lower to the 100% level. Now, here's a trade setup to the 100% level. If I were to go to the 15-minute time frame, you can see the entry. Here's the first retracement to a 15-minute fair value gap when you're looking for a trend continuation. As you can know, we're looking for a trend continuation for price to trade to the 100% level. So 15 minutes fair value gap and an order block. We can see how price respected the order block and the 15-minute fair value gap led to lower prices to the 100% level of the standard deviation as our target we identified during the London section. So back to the 5 minutes. So this would have been your trade idea on Wednesday. Let's say you use this stop at this high and your target. This is close to 3-hour trade. Close to 3-hour trade, well executed. Nice trade setup before the retracement back to the daily range after 8:30. So this are the scenarios where I talked about the retracement back to the daily range after 8:30. You can see that here's 8:30. 8:30 price trade to the standard deviation 100% mark. After 8:30, retracement back to the daily range. So if you are trading a bias from the London section and there's no deep retracement during the 7 a.m. to 8:30, if there's no deep retracement, remember that if there's no deep retracement to a fair value gap, a deep fair value gap, the 830 will lead to a retracement back to the range, back to the daily range. And you don't want to be looking for a trade after 830 in scenarios like this. So you can jot it down, make sure to add it to your trade plan and to your limits on how you take trades. So after 830, press the retracement back to the daily range. So that was why I talked about when I talked about the 7 to 10 a.m. trade setup, I make sure I talked about the 7 to 8:30 and the 8:30 to 10 a.m. It's depending on how price traded before 8:30 that will tell you what price will do after 8:30. And don't look for this trade. Don't try to catch this trade. It's somehow complicated. There are some times where price will just consolidate throughout, but later on lead to higher prices. It's better for you to stick to the buys, and price already took out the swing low, the 4-hour swing low. So in most cases, price will be leading to a retracement back to the range, back to a 4-hour fair value gap, which was this 4-hour fair value gap. And if price was to do a retracement to the 4-hour fair value gap, when would the retracement start? So these are times where the retracement will start at 8:30. After 8:30, retracement to the fair value gap. But this would have been your setup before then, your 3 a.m. to 4 a.m. setup on Wednesday, where you took a 2.7-hour trade. If you were to use the 15-minute entry, it should have been around 2 hours or 3 hours. Let me measure it and see. This would have been your entry. And your targets would be swing low. Oh, this is a 3-hour, 3.4-hour trade. Or if you take both entries, this is around 5-hour trade. Total 5-hour trade. So that was how price traded on Wednesday. Now moving to on Thursday. Now on Thursday price action was a little bit tricky because price traded to the 4-hour fair value gap, stayed inside the 4-hour fair value gap. Now in the scenario where get it to your trading time and price is still inside a fair value gap from a higher time frame and you are looking for lower prices, you want to see price run out some sort of liquidity before looking for your entry, because in most cases price will seek out liquidity during the London section before trading lower or higher. Or well, if you stick to your 3 a.m. to 4 a.m. entry, you mostly could have avoided price before then. So price traded higher, run out this high, run on this high, and went for this high, running out the previous week, sorry, the previous day highs. After it run on the high, retracement led to lower prices. Let's take this out. This was actually where things got a little tricky for me on Thursday, because price day retracement back to the daily range, but price traded through the daily range and there was a high impact news that led to higher prices to the 4-hour fair value gap. Now, based off our trade idea, let's look at the 3 a.m. 3 a.m. and 4 a.m. This was the setup and price stopped me out at this swing high here. That was actually where I was stopped out. So this would have been an entry, fair value gap. So at a minimum, look for a 2 to 1 hour trade and 3 to 1 hour trade, depending on the swing level. But this was more than that. This was more than the trade, but price failed to run out to the slow. That led to the retracement, but this was the setup. You can see how price respected the fair value gap. This was supposed to be our target, and I was looking for more target lower because this was on Thursday. I was looking for it as the last price level for price to trade lower before the retracement during the New York section back to the daily range, but price retraced without even going close to my targets. This is actually where I took out the trade before the retracement back to my stop. because look at the swing level: retracement, fair value gap, retracement, fair value gap, stop loss at this high. So I'll be doing a live execution on how to manage trade. I'll be doing a recording once I execute the trade. I'll be doing a recording on how I manage the trade to price trade to my target, and explain on the specific way I do enter on my setup. Sometimes when there is a fair value gap like this, I mostly use the mid-range of the fair value gap. When there's a big fair value gap, I just use the mid-range as my entry. In some cases, I just wait for a re-entry on 1 minute. I will explain more on it on further lectures. Retracement, run at this high, stopped me out. Now the 15-minute retracement to look for a trend continuation on the New York section from the price range of 7 a.m. to 10 a.m. Here's the fair value gap. And there was a high impact news, so which means I was waiting for the high impact news before looking for any entry. And after the high impact news, price traded against my bias, and that was it for the day. I didn't do anything after it. So 8:30 high impact news led to higher prices. There was no shift in market structure leading to lower prices. Price traded higher to this fair value gap, respected the fair value gap, but I wasn't looking for an entry, so price traded lower. Now on Friday, that was actually where I caught the most of the trade. That was actually where I caught the high reward to risk ratio. So what there's one specific thing about this setup is that it gives you advantage to catch a high risk to reward in some scenarios. At the same time, it gives you an opportunity to catch a 1 to 2 and a 1 to 3, like the trade we took on Wednesday, which was a 1 to 3 and a 1 to 2.7 R. So on Friday, 4-hour fair value gap, retracement to the 4-hour fair value gap on a 5 minutes, executed the trade, led to lower prices. Price run at the swing low. And we'll be looking at those trade setup based off the trade idea. So let's go to the 5 minutes. Let's go to the 3 a.m. on a 5 minutes, 3 a.m. Let's go to 3 a.m. So here's 3 a.m. So 4. So here's the trade setup. Now the 3 a.m. open, price just shift structure, running out the swing low. Got to 3 a.m. Price used the 3 a.m. to trade into a fair value gap. Remember, if the 3 a.m. is trading into a fair value gap, that's an entry. If there's a fair value gap before 3 a.m. and the 3 a.m. is trading into the fair value gap, that is an entry. Which in this example, you can see that price traded into the fair value gap. After it traded into the fair value gap, this would have been your entry, which was actually my entry, because I normally look at price far before the 3 a.m. I look for at price immediately at 1, around 12 a.m. I look at price at 12 a.m. before going lower to my time. So price traded lower, your target the swing low. Now there was still entry. We can see a fair value gap within the range. So let me move this. I'm trying to move this rectangle to the entry. Okay. So you can see there's a fair value gap within the price range. This would have been an entry. Lower prices, your target will be the swing low. Remember, you can still use your standard deviation to measure for more targets. If you're still anticipating price to trade lower, you just measure from the swing high to the swing low. 100% mark as your overall target. But in this example, due to the fact that price already did a retracement and the last trading period from the 8:30 only traded to the 50% before a complete retracement back higher. So let's mark out the 50%, 50%, and the 100%. Price failed to trade to the 100%, but targeting the 50% gives you around 4 hour, a 4 hour trade setup. But take your target at the first swing level of the 4 hour at your early stage. Holding a trade during all this retracement and back and forth might make you close your trade a little bit more earlier, or closing it where price already retraced fully back on your profits. So the first trade was a 2.5 hour trade, and this might be a trade where you hold to the 50% level, or maybe not even hold to 50% level because price haven't run out this low. Remember, when using a standard deviation, wait for price to run at the swing low. You need price to run at the swing low so that you know that you are targeting target after price after there's no 4 hour target to target. So that's why you're using the standard deviation. And this was a 2 hour trade for price to trade to the swing low. So total was around 4.5 hour using only the fair value gap before the 3 a.m. and a fair value gap inside the trading period of the 3 a.m. to the 4 a.m. And in this example, we're going to talk about the 8:30 because on Friday there was an 8:30 trade setup that gave the most of the profit. So at 8:30, before 8:30, you can see what I was talking about, that if price were to use the 7 a.m. to the 8:30 to do a retracement back to a 15-minute fair value gap, then you'll be anticipating the 8:30 to lead to lower prices, mostly going back to the London low as your target, running out London low as your target. So on the 15 minutes, if you look at the 15 minutes, here's a 15-minute fair value gap. Let's take this out. Oh, let's leave it. I'll just mark out the fair value gap. Here's a 15-minute fair value gap. There's still more fair value gap. There's a fair value gap below, but I'm just marking the specific one where price stopped and retraced. So 7 a.m. price the retracement to fair value gap, running out this high at the retracement. So at 8:30 to 10 a.m. trade setup. Let's go to the 5 minutes. Here's 8:20 retracement, 8:30 price traded lower. There was no high impact news, so you can execute on this. Here's an order block. Take your entry at the order block. You can see this. Here is the shift to market structure, traded lower, retracement, retracement, order block. And where will be your target? You just target the previous section low, which is the London section, or if you have a standard deviation you already marked from higher time frame, you can use either of them. Remember, do your own back testing on where you'll be looking to target. It do helps. So led to this 4.6 hour trade. So you can see we do have a trade. We do have a few, not actually losses. Throughout this week, I didn't actually have a loss. It was only break even, 3 break even, and nice trade setups. So on Friday, you took a trade in the morning and you took a trade in the PM section, or let's call it the New York section. So both sections you did execute a trade. On Thursday, you executed a trade, but you were stopped out at break even. If you were to use this trade idea correctly, and on Wednesday, 3.4 hour trade and a 2.7 hour trade. So you can see only 1 week gives you around 10% profit if you wait for the specific time use that was explained on previous lecture, because this was a 3 5 Let me see. On Wednesday, it was a 6 hour trade, total trade, break even, break even. There was no losses. In most cases, I do take losses, so this is just a scenario where there was no losses. It was just a winning streak and break even. 6 hour plus the 2.5, and so 4.5, which was 8.5, plus the 4 hour 4.5 hour trade, which was around, it was more than 10% profit made in a single week if you were to apply it correctly, execute on the trade setups correctly, and you took your target at the recent swing low. As I explained, here's the recent swing low, your first target. The second target, price having traded to this recent swing low, you banked in your 1 to 2. And your last target, recent swing low at the London section, price traded to the recent swing low, run at this low before a retracement. And you can see how you execute a very nice trade. So using a trade reversal, I talked about the rules. You can go back and watch the video a few times to understand the rules, and make sure you write down the rules, because these are trade plan. These are trade plan that have been explained. Trend reversal led to lower prices. So make sure to do your back testing based off this trade idea, and learn how to trade a candle reversal, a weekly candle reversal candle, and already know the rules. Watch back this video a few times to know the rules. And I think that's it for this lecture. See you guys in the next lecture.